So bonds have lost their luster as a repository of wealth, and it might be permanent. But what about the repository of wealth that stocks represent? I remember the day I first walked into Goldman Sachs. It was 38 years ago. And I got schooled by someone who's now an old friend about the value of stocks versus bonds. Oh, I love stock market. That's why I went to Goldman. I mean, I love stocks. I had all these tremendous ideas. I wanted to tell everybody about them. He let me go on and on until I named enough stocks to create a Jim Cramer index, and that was before there were ETFs. Then he looked at me and he said, never mention those stocks or any other stock ever again, ever. What the hell are you talking about? I love stocks. I'm a Goldman. I love stocks. He told me, let me let you in a little secret. Stocks, they go down. Bonds, they don't go down. I said, but I could never make that promise. I wanted to make people money. This is Goldman Sachs. He basically said, no, I know what I was talking about, especially since the clients I'd be talking to were already rich. You only need to get rich once. All these people simply wanted to do was preserve their wealth. They didn't care about generating huge gains that I couldn't deliver on anyway. Okay? Stocks go down. Bonds don't. But what if they actually wanted to own stocks, I asked. And he said he told me that I had to discourage them at all costs to ever buy a stock. Because if a single stock went down and they lost money, we'd lose the whole account. So I begged him. I said, well, what if maybe let them buy a couple stocks? He said, make sure it's their own ideas. You keep your ideas to yourself. As it happens, I ended up doing both. I helped my clients stay rich, and I kept my ideas to myself. Specifically, I invested my own money. I made a fortune enough to own hedge fund, and then retire and do the darn show. That's my life's arc right now. It's all right. Could be worse. Anyway, it worked out well, I think. But what does this story have to do with today's miraculous rally or the endless rally? Frankly, everything. Everything. And no one else is talking about it. You see, if you put me in charge right now of that Howell division at Goldman Sachs, I'd say when rich people come to see you, you have to tell them that they need to take less risk and preserve their wealth. That means they need to own a lot fewer bonds and a lot more stocks. Yet this year we're witnessing the passing of the torch. Bonds were the safest assets back in '82, back when Treasurys yielded double digits. Now they're risky assets, maybe riskier than anyone thinks. Sure, you only need to get rich once, but if you want to stay rich, the old shibboleths won't work anymore. The truth is, for many companies that we follow, the equity side is a much better, safer side, a much better repository of wealth for you, the individual, than the credit side. Not all of them, but a surprising number. Think about what's 25% of this market? It's the Microsofts, the Apples, the Facebooks, the Apples, right? They are sitting on more cash than most countries. Microsoft's got $138 billion. Google's got $133 billion. Apple's got $192 billion. Even the smaller Facebook has $55 billion. Collectively, they're richer than everybody. Think about it. They survived the Great Recession, and what happened? They came out stronger. The countries didn't. In the Great Pandemic, they're not just thriving, but they are actually putting up unbelievable numbers. The countries, they're hoping to survive. These guys are thrive. They haven't been touched by our crazy presidential politics at all. It hasn't laid a glove on them. In fact, these big tech CEOs are so statesmanlike, they make most of our politicians look like they're from Hail, Fredonia. To mix metaphors, Facebook, Apple, Amazon, Microsoft, FAM are the Fort Knoxes of our era. They'd be prime targets for Goldfinger, although he'd fail, of course, because Sean Connery, whom we miss very greatly, Sean Connery's Bond would stop him. No, I take that back. Forget Bond, James Bond. From now on, it's stock, James Stock, because these stocks are the new repositories of wealth. That said, it is a brand new thesis, I admit that, even newer than the love affair with Bitcoin. You might dismiss it out of hand, but in a world where some mysterious figure creates an invisible currency and nobody knows where he lives, it's loved by the rich, I think you'd have to be nuts to consider equities a second class to that, let alone bonds. Yeah, gold's got some luster, the gold miners are okay, but, you know, and I like being able to feel bullion. That fits better than staring at a ledger. The real lesson, though, of this era, of this week, of this month, of this year, is that stocks are the ones that don't need government help here. Bonds do, the bottom line. That means if you're a young, wet behind-the-ears broker at Goldman Sachs, I would tell you to forget all those bond ideas. Just tell your clients to buy the stocks of terrific companies with fantastic nation-state-sized balance sheets. You'll do much better with a heck of a lot less long-term risk and more dividends.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.